Okay, thank you very much, and it's a pleasure to be here and to have us at the conference. So I will talk a little bit about the implications the new digital asset infrastructure will have on financial institution and market infrastructure provider. So therefore, just a couple of words about myself. I'm a partner in our German EY technology consulting practice, and I have two roles. One is I'm leading our capital markets practice, and the second is I'm leading our financial service blockchain solution. So if you bring both worlds together, then of course the tokenization of assets and digitalization of capital markets is one key aspect and a focus area we are working on. So to set the scene a little bit, we brought a message here from Robert Crayfield, who said that in 5 years' time, 100% of the stock market and 100% of the bond market will be tokenized on Wall Street, which poses two challenges. I mean, first of all, on a time perspective, 5 years' time is, of course, short, and also to emphasize on tokenization of the two most liquid markets we have in financial systems. So how to do this and how to approach this? So I think 2020, as a lot of speakers have been mentioning, has been a key year for the adoption of digital assets in a couple of aspects. I mean, of course, we have a regulatory framework which is kind of clearing out, and we see a lot of regulation coming up on a global scale, but also here in Europe and in Germany. We have the breakthrough on central bank digital currency, and also we have now scalable infrastructure providers who provide technology which we can use for mass adoption in this sense. And of course, we see an increased demand on digital asset and tokenization. So therefore, I think the framework is there to really leave the experimental state and to think about how to adapt this in a productive production environment. And I think that's also what we see, that a lot of financial institutions and market infrastructure providers really take this seriously now. So when we look at the current market infrastructure for securities, and this is of course just a schematic view on how it looks like today and only in a European environment. If we take this on a global scale, then of course the page wouldn't be enough to summarize and to picture the infrastructure. So we see there's a long way to go if we have securities coming from an issuer until it ends up at the investors or on the sell side. So therefore, the market infrastructure which has been built today is complex, but we have an infrastructure which has been optimized over decades and is at the end of the day still very efficient. Because I think we need to be a little bit careful when we talk about efficiency. So efficiency from a capital markets perspective can be measured on liquidity and on effective pricing. And of course, the two most liquid asset classes like bonds and equities are running on this infrastructure. So to say that this infrastructure in general is inefficient is probably not appropriate. But nonetheless, there are a lot of players active in this market, and of course all of these players need to think about what the new infrastructure will mean to them. And of course it's a playing field for new market participants. So if we have a schematic view on how potential new infrastructure could look like based on a DLT technology, then this raises a lot of questions from market participants and for infrastructure providers. So I mean, first question really is, where should institutional investors hold their assets, which is a key question. And I think we have heard, and we will still continue to hear, a lot of opinions from challengers, from new entrants, from fintechs and others on where the assets should be held. But still, we need to keep in mind institutional investors want to keep the assets in one place to have everything together. So a second question really is this a new infrastructure we should build besides the existing infrastructure? So, and I think I will come back to this a little bit later on, but the key question really is, how do we integrate the new technology and the new infrastructure in our existing world? Because as I said, from an end user perspective, from institutional investor or a bank perspective, we need to keep efficiency. This is key, otherwise it will not work. So the second question is, or the third question is really how much business processes we can move on-chain. So because when we want to achieve cost efficiency, then there are two playing fields. So one is that we can provide an infrastructure which is far cheaper than it is today, or we take out some of the business functionality from current infrastructure providers or current service providers and move this on blockchain. So I think that will be key going forward to move these business processes, centralize them, and maybe make the blockchain application more suitable for business processing. And of course, the last point is really on how will this network look like? Because, as I said at the beginning, so financial markets is a global financial market. So we not just talk about Germany, we not just talk about Switzerland or Europe, we talk about global financial markets or global financial market system. So therefore, how to integrate across jurisdictions and how the whole global infrastructure can be combined with this new technology will be a key aspect. But nonetheless, all of these boxes, all of these institutions need to really think about their role they will play in the future in this new market environment, because digital assets is not just a new asset class we are also creating new marketplaces. So therefore, of course, it has opportunities for existing infrastructure providers, but also it has a threat. So when we just look at the benefits and just some thoughts on what we think how these goals could be achieved. So I mean, the first is really that we want to achieve an infrastructure which has lower service, operation, and transaction costs. So I think the first point is really that we need to integrate this new technology in existing infrastructure, because from an end client perspective, from a user perspective, nothing should be changed. I think the worst case would be that we have two parallel worlds where we basically have the same asset issued on two infrastructures. Of course, this would lead to a bifurcation of the market and potential decrease of liquidity. And I think it's a worst case that we imagine that we have an equity issue on two infrastructures which have different prices. So therefore, I think it's really key to integrate in the infrastructure, because if we rebuild the infrastructure, then the question you can ask yourself, who's paying for that? So the second thing is, as I mentioned earlier, we need to transfer business process to DLT. I think that's an important point. And of course, we need to centralize service providers and allow disintermediation. So that we can reduce the number of service providers, which currently drives cost. So the second benefit is, of course, that we want to achieve a true digitalization of capital markets and increase efficiency. So I think the first point is really, and we heard a couple of talks on that, is really to think about how we can increase efficiency in the current infrastructure. We heard about the ideas of reducing settlement cycles on securities. We have other markets like derivative markets or the collateral markets where we can actually gain benefits by using DLT technology in existing infrastructure. The second point is key. We need a buy-in from all market participants, and to avoid parallel worlds and bifurcation of markets, what I said earlier. And I think that's an ambitious goal we all have. And of course, we as EY, as an independent advisor, will take a lead on that to take everyone on this journey. So, and then the third point is important, that we need global alliance and global alignment between regulators. We know there's the OECD is working on that to achieve this between the policymakers and regulators. I think this is really important to really gain efficiency in the global financial markets system. So the third benefit is, of course, we can make currently illiquid assets tradable and, of course, increase liquidity. So tokenization of assets is an important thing from issuance perspective, but I think we should focus also on marketplaces, because if we do not have a secondary market for these assets, then of course we will not have liquidity which is sufficient enough for institutional investors to dive into this and to really gain benefits of the infrastructure. So the second point is, it's really important that the large liquidity providers are buying into this, because it's important that the big banks and the buy-side firms are really buying into this to provide liquidity. Otherwise, we will not succeed in a mass adoption, and specifically not if we go back to the statement from Robert saying that we have a tokenization of the bond and the equity market. And of course, the third point is really we need buy-side adoption. So I mean, most of the assets are on the buy side. So if the large mainstream asset managers are not really included in this community and not playing their role here, so then it will be very hard to bring a mainstream adoption to this. And the fourth point is, of course, traceability and gaining transparency on-chain. So therefore, I think there needs to be a focus also to bring out the benefits, to what benefit it plays for regulators and tax authorities on gaining this transparency. And also, I think we can, it's not just full tokenization, which is key, but also using traceability option or traceability solution to increase transparency. So really the question is, how should financial institutions approach this transformation? And we advise in three areas. So first of all, it's really important that for all these service providers I showed at the beginning, for every box, every institution needs to review their business model and also their client offerings. So it's really important to understand which client wants to act in which market. It's important also to get an alignment across the organization. As you can imagine, if you talk to global organizations, they have a lot of people in different regions working on different use cases, but really align the organization and to review their service offerings going forward. So the second point is to work on the target operating model, which is very important because when you today talk to people who are familiar with the infrastructure I showed at the beginning, then those people have been working in the industry for 25 years. So if we want to embrace them and to adapt to the new technology, we also need to take all these organizations with us so that they understand really what it's all about. So governance within large organizations is really important. And of course, then banks or financial institutions in general need to make a decision on the IT infrastructure they are using, and they need to start really playing around using POCs. And when it comes to POCs, we have three areas. So I think our advice is really to start with internal POCs within their internal organization, then talk about or dive into use cases with their franchise, and then of course take part in market exercises, which we will see next year coming out, as we heard in these talks. And then the third aspect is really around learning and communication. And I think that's something to focus on, really to develop internal understanding within their organization what this is all about, and also to take it's a responsibility for these financial institutions to take their clients on board and take them on this journey so that they also understand and of course engage in industry-wide initiatives and keep track on regulatory environment and also on developments. As you all know, I mean, it's crazy if you read all this stuff which comes out every day. It's a massive undertaking. So therefore, I mean, how can EY help these clients? We have a full stack consulting service set up for digital assets. So we, as a global organization, can advise along the value chain. So we have, of course, we advise on strategy and business model development, and also on the technology side, financial institutions should adapt to. So we have a practice set up which can advise on all compliance issues, financial statement issues, so finance and general risk and compliance. And of course, we have a law firm which can help on the legal challenges and the regulatory challenges ahead. And this is embedded in our EY Global Capital Markets Network. And of course, we as EY also stay very close to the regulators and have very good insights and connections. So, but this consulting service is extended, of course, by our technology solutions, and I think this is something which probably is not so much well known in financial service industry. We have a very active development team, so we have our own tools developed. We are a significant contributor to the Ethereum community. We have been working on the baseline protocol and other protocol solutions. We have two main tools we are using in financial services. Is our ops chain solution for traceability, and we have our blockchain analyzer, which helps us to make for assurance work, but also to support our tax compliance for clients who are already using digital assets. So to find out, you can check out on our website blockchain.ey.com, which gives free access to our tools so we can play around. It's available for everyone, and I think it's part of our strategy to support the community. So therefore, thank you very much for listening. We have just a couple of bit of advertisement. So we have a blockchain summit here in the European area, which is coming up on Monday next week, where our global blockchain lead will give some insights on our strategy and vision, but also where we show our tools. So feel free to join. And of course, we will stay around today. You can meet us outside in our little corner. So therefore, thank you very much for listening.